the future of Intel. The beaten-down chipmaker reports fourth quarter results after the bell today, as incoming CEO Pat Gelsinger is set to take over the company later on next month. Now, he is replacing Bob Swan, who has experienced some big blows since taking the reins back in 2019, including massive chip delays and the end of a 15-year partnership with Apple. And it shows on the tape as well. Intel's down nearly 3% in the past year, while other chip makers, as you can see there, big green arrows, they're soaring. NVIDIA's up 119%. John, Fort, is this the beginning of the end of Intel's pain?
Boy, hard to say, Dom. That is the question. I mean, because Pat Gelsinger, here's a guy who almost literally grew up at Intel. He was a teenager in rural Pennsylvania before he came to Intel, literally as a teenager, spent 30 years there before leaving. Now he's coming back. And a couple of years ago, I basically suggested that he would be an interesting candidate for the top job at Intel. And he said, no, thanks. He responded to me on Twitter, said software is the future. Well, I think software is potentially the future in the chip space as well, especially given what's happening in the enterprise and in the cloud. So I'm really eager to hear what his game plan is for Intel, beyond the obvious manufacturing issues that they're having for working with the Amazons, the Microsofts in the cloud, and then those like Apple that want to design their own chips and peel off from the Intel path.
Mike Santoli, the Intel story has been one where there have been attractive qualities. It's a value-oriented company. It pays a decent-sized dividend. What exactly then gets investors excited about a company like Intel?
Well, there has to be a persuasive message that they've, in fact, found a way to redevelop or maintain an edge somewhere, because the way the market is valuing the stock is really in almost runoff mode. It's like a 7% free cash flow yield, if you want to think about it that way. It's like, 13 times free cash flow, what they're producing today. This is a company that has spent $10 to $15 billion every single year on CapEx, and the stock has been sideways for 3 or 4 years. Very tough for tech companies to get out of that value mode where they're considered to be, kind of zero growth or very low growth. So I do think whether, in fact, they can say that the design piece is going to be their edge in terms of the various emerging chip areas, and they can do something on the manufacturing side that is makes them a little less capital intensive. We'll see. All right, Intel results after the closing bell today, guys. Next up here, we've got the street loving Google, Alphabet. The stock is at a record high. Piper Sandler naming Alphabet its top pick, giving it an overweight rating and a $2,056 price target, saying in its note that Alphabet is much more than just a digital ad name or a machine, writing, Alphabet looks more like a diversified internet technology ETF levered to mobile apps and software and video and cloud, etc. Piper also shrugged off the idea of regulatory pressures being an issue. Last week, the B of A analysts over there named Alphabet their top FANG pick for 2021. The shares are up just 10% in 1 week. Deirdre, can Google be stopped?
Yes, Dom, it can be stopped, and regulators are certainly working on that. When you read these notes, regulation is almost like an afterthought. I was reading the Piper Sandler one. They had at the end, it says, regulatory doesn't look like an issue, ... in brackets, yet. What I worry about is whether investors are perhaps complacent. Regulation isn't going to be likely is not going to be this one moment where the company is broken up, but it's going to happen over time, and we are already seeing this happen. Google has been fined, more than $10 billion in total on either side of the Atlantic. That hasn't done much. But the next phase of regulation is looking at structural change. We know that Europe is doing this. The draft rules that were put out last month were some of the most aggressive since GDPR. And we don't know if this is going to result in actual action, but I would just argue that it is treated much like an afterthought. And even with the Biden administration coming in, as some think that it's going to be more friendly towards big tech, it is going to be really hard to stop this momentum that has been building over the last few years.
John Ford, I remember kind of the earlier days in my career when I talked about Microsoft in the same way that we talk about Alphabet today from a regulatory risk standpoint. Facebook has been a more recent example of that. Mega cap technology seems to overcome all of these hurdles. Why is it that Alphabet is maybe not going to do it, as Deirdre says?
Well, I mean, it overcomes those eventually, but Microsoft went through a very long dry season. You can see it in the stock chart between 2000 and about 3, 4, 5 years ago. And I think the threat the danger for Alphabet, for Google, is not that their business completely falls apart under regulation or something else. It's that they lose their mojo. They lose that sense of investor belief that they are in the lead and growing. So I think the danger is that Amazon continues to lead in the cloud, that Amazon moves into advertising even more aggressively and starts to have more success there. And investors just go, maybe Google's yesterday's news, they don't deserve this kind of multiple. Because Microsoft was growing revenue and profits gangbusters throughout the 2000s and beyond. They just didn't get the valuation credit.
Where exactly, Mike Santoli, does Alphabet unlock that value? Where do they get that investor kind of optimism and excitement going for them? What do they have to show?
Well, what's interesting is that I would argue that investors are not very worried about the regulatory threat, because the story with Google from a Wall Street point of view has always been, just please let the core black box algorithm run. Like, stop doing all this other stuff. Stop trying to enlarge the empire. We just want you to be a dominant in search and essentially monetize the overall move into digital advertising. So maybe the idea that they do have their sales trimmed a little bit is not the worst thing in the world. But of course, they have to show that that core advantage is not under threat, that their basic ability to monetize search is not going to be lessened by whatever scrutiny there is, whether it's how they privilege their own search results or something else.
Shepard Smith here. Thanks for watching CNBC on YouTube.